All right. We are live, and this time around, I am actually paying attention to the chat, which is the mistake I made last time. So now I know where it is, and we can be a little more responsive. This topic of cap tables I find interesting because it's one of the places that I think there is a lot that gets said about it. And there's a difference between the reality and what people sort of kind of pass around. So we're going to try and create some clarity. But first, I want to let my guests introduce themselves. So, Holly, thanks for joining us.
Thanks. So I'm the managing partner of Apprentice Ventures. We invest at the pre-seed seed in founders leveraging AI and machine learning to digitally transform legacy industries and the cyber solutions that secure that transformation. So I started long ago on the operating side at GE, did a 180, was on Wall Street for a decade, um, and part of their on balance sheet principal investment group. So I've invested across everything from venture to PE to distressed and helped run an early stage cyber company as well. So I've gone earlier and earlier throughout my career. I'm excited to be here. Thank you.
Cool. Thanks. And Colin, welcome.
Yeah, hi, I'm Colin Kirby. I'm a head of the emerging companies venture capital practice at Foley Hoag. I've been mucked up cap tables now for about 16 years.
And just to clarify, you're not doing any of the mucking of the cap tables. You're just
I'm
unmucking.
trying to do the unmucking. They hired me
Okay,
for the
gotcha.
unmucking after they're mucked.
Yes, gotcha.
So you have a counterpart there that's
Unmucker.
doing the mucking.
Somebody's doing it. And oftentimes it's, I know a lawyer and they'll be really cheap. So here's a question, it's just a level set. So when we talk about broken cap tables, are we actually talking about and where it becomes problematic, some kind of like intractable mathematical or economic problem where there's just some hard and fast line where something becomes unworkable? Or is it more of a like signaling problem? Like if there's a messy cap table or, um, something that appears, founder unfriendly, uh, it makes the founder seem like bad at negotiating or naive, or maybe that, there wasn't competition around this deal. Holly, I'll throw this over to you first.
I'd say it's a bit of both, but I would lean much more heavily towards signaling. From my perspective, and just given a lot of my distress background, there literally isn't a cap table that can't be cleaned up with the right amount of time, effort, money. There's tools to deal with ex co founders who've walked away with too much equity or crammed down bad actor investors. Like most things can be done. And it's just, time and cost relative to the value that you see in the company. But most venture investors, because they have a huge pipeline of other deals, just see a mess and move on. Not me though. I like a little bit of mess. But I am more interested in the signaling aspect because I think it's like specifically, was this a point in time decision that reflects a tough situation that you were able to navigate successfully through? Or is it a pattern that shows repeated decisions or bad judgment that will likely repeat? Like this, the goalpost for startups keeps moving. So there's going to be bridge rounds and things happen. But how you act over time and do you learn from things that you've done in the past? And is that compounding? These are all things that can be worked with if you're transparent about it. But it's definitely more of a signaling thing for me than a math problem that can't be solved.
Given that, Colin and Holly, you brought up a couple of reasons sort of to get clarification around like what actually happened here. Colin, in your experience, what is happening most of the time that things are like this, that it gets to this point?
So I think first of all, I just want to separate like broken cap tables. So I sort of think of them in two ways, but they're going to intertwine a lot throughout this conversation. One is administratively, the company hasn't done anything to maintain their records. We're supposed to give stock options to 50 people. We gave the options out the wrong way. They need to be unmucked. Um, and the other, so that's sort of like a administrative side. On the other side, we have like a business oriented issue. Like we gave a founder at the seed stage 20% of the company fully vested, and she's gone. And like that's just dead weight on the cap table. We have to unmuck it that way. And that's more of like a business procedural thing. There's nothing administrative wrong with it. But these things tend to like blend together. And I think we'll see, we'll give a few instances of where. In terms of, I agree it's signaling. I think there's a few things that can be red flags for when you're looking at one of these issues that you can sort of tell something's wrong with the maybe investor or founder relationships, or some aspect of the negotiation. I rarely see this as founders being poorly negotiating. I mean, I think you sort of get the deal that's on the table, and if you've got good advisors, you that's sort of what the market dictates. But red flags I see are angel or seed investors still on the board many rounds after they're they've invested, and especially if they haven't participated at all. So if you have an investor on the board that didn't participate in the last round, that's like not a good sign. This happens at the angel stage, but investors with like really funky anti-dilution rights. If we invest, we got 20%, and then if you raise another 5 million, we keep our 20%, and only you, founder, get diluted. Or like an investment team that looks at it like an incubator and takes 60% of the company. If we don't have a founding team that's incentivized enough, I think probably Holly can attest, like we don't like that structure. We don't have the right incentive dynamic going into it. But yeah, that's sort of like a few of the warning signs I look at, and board record keeping.
Colin, that's actually a perfect window for me to remind everyone who's making this video possible. When you talk about the administrative stuff, I imagine that a lot of that can be solved with a cap table management platform, and Qapita is actually our sponsor for this conversation today. And so would you say it's fair to say that if you use a platform like that most of the basic administrative, like this got uh, uh, distributed incorrectly, or there was sort of a failure, a management from the technical side of it, is most often solved by using one of those platforms early?
Yeah. I don't know about solved. Like you can
You
still
still have a mess.
like make a footfall pretty badly. However, you like what we see without a cap table management pool, a cap table management like SaaS product, is you get in a really deep hole, and like things get really messed up and no one fixes anything. No one even realizes there's a mistake. What a good cap table management platform does is keep you from getting too deep into that hole. You got a footfall here or there. We finish it in diligence before your next round. It tends to keep you from going step 3, 4, 5, where like the real sort of brain surgery and brain damage on like tax and whatnot really hurts.
Gotcha. Ali, you brought up, and this I hear from VCs all the time, this is something that other VCs would pass on, but not me. And what do you put in the category of things that you are willing to work with and why? And then things that maybe even you wouldn't touch. And as a follow-up, like, how does a founder even know that, I mean, you've now put this out there, right? So no one who sees this video should walk away from you passing on them feeling like the cap table is the issue, right? Because you said, hey, you're willing to do this, right? But a lot of founders walk away feeling like there was something like this that was the reason for the pass. And how do they actually know?
Yeah, I mean, I think a lot of times, just as founders get fairly vague passing rationale, it's the same way that I do from LPs, right? So there's just this stuff is happening all over the place. If an investor is really interested, there's just very specific and actionable things that you can do. They'll give you a list of things that they want to see done to get the deal done, right? So if there's you've got a departed co-founder situation, you have to get it resolved, like get us X documentation. And oftentimes they'll help you too, right? Show us that this unsigned doc isn't a potential liability down the road. I think, lack of interest sounds more like, yeah, the cap table feels messy, or we need to see this cleaned up, like very generically. You gave away too much equity. Like all those things with real interest can be fixed. So if there's just no specifics and it's just super vague, I mean, I would just try to take that as, it's not personal and move on, because it's likely just an excuse. The things for me that I think that you really can't get around, or like really hard stop red flags, is, and I mean, besides the things that like Colin mentioned, like, you might have poison pills tucked away provisions in side letters or docs or anti-dilutions or blocking rights. Like those things still could be negotiated, but it might take a little bit longer. But I think that a cap table can show you whether you have an ethical founding team or not in some respects. And that's where
Yeah.
it can be a showstopper because if, I operate under the assumption that kind of life's messy, startups are messy, cap tables are messy. And the question is like, how do you own it and are you transparent? Founders who are upfront and say, hey, we did these things early on. This is why we did it. Here's what we learned. Here's a doc that I know needs to be cleaned up. Like that's fine. You can kind of work with all of that. But if you have to go through diligence and you're like piecing together what actually happened and trying to construct a narrative because it's not transparent, then that's where it gets messy. It's like, okay, Bob and Jill put in 100K roughly at the same time. And then at conversion, Bob's stake he's going to get like $1 million and Jill's is like 200K. So like when you see a pattern of that type of stuff over time, that's a showstopper because if you play games with your equity, you'll play games with your POs and your revenues and customers. So that's kind of what I look for in those messier cap table narratives.
I had a founder pitch me and they owned 60% of the cap table and the other of the common and the other founder owned 40. We're going through all this due diligence and I wound up offering a term sheet. And one of the people that I had sent the deal to said, well, how do you feel about the fact that so-and-so is not full-time? What do you mean they're not full-time? It's like, he does something completely different. He hardly spends any time at the company whatsoever, yet he owns 60% of the common. And it had never occurred to me to ask. Like I just, two people come and pitch you and they're talking together about all the things going on at the company. The idea that one dude's there 2 hours a week at most and the other person is shouldering all of the work and that they're not sort of being upfront about the relationship was sort of a non-starter for me. Had no idea. So now I know that's a diligence. Like, by the way, is everyone on this full time? What are some of the ways in which, let's take like either debt equity or co-founders who have left. Sometimes it's all about vesting. I feel like there are two parts of this. One is what can legally be done. And then sometimes it's about founders having just hard conversations with people where they may not feel like they have leverage or it's a conversation they want to avoid. And I'd be curious about, Colin, we'll throw it back to you and Holly, if you have something to add. How do you advise founders to have those tough conversations about changes and fixes?
It's tricky. I mean, I get questions from founders with like, okay, so and so left with 40% of the equity, and Holly and her team won't invest until that's like down to like 20%, and like, so what do I do? And I'm like, I'm the lawyer, man. Like, like you gotta go talk to your co-founder. It's they have leverage against you. Simply put, like you need to. Oftentimes, it's business conversations that need to happen to like fix messy cap tables, and that can be. I mean, unfortunately, you get former co-founders and really former investors with like a lot of extortion power, for lack of a better term. And I think the play there is always, it's a total trope and a cliche, but like, look, you want 40% of a $3 million business, or you want 3% of $1 billion business, right? Like, and this grows, like all ships rise. And this is like what I teach my associates. I've got this like the Tao of venture investing, and Tao of dilution, which is basically like you can hang on to all your little percentage points, and you can be very crowded about that, but you've got to be able to release control and accept a deal if it's going to be better for the company and it's going to like really improve everyone's play. It's not as venture, more so than other asset classes, doesn't exist in a vacuum.
Would you tell people to get that taken care of before they go out to raise or see what the market plays?
If it's a fringy issue, we're a seed company, we've got 5-10% of dead weight. That's like not the end of the world. I'd say maybe we can wait and see like what the investor's sort of appetite is. If it's a big issue, I mean, I'll just tell people straight up, like, you're not going to get a dime of money until you fix this. And that's a hard message because often, obviously, like the company doesn't have capital as one of their resources in terms of like getting what they need done. And oftentimes they're depending on that capital to do it. And I think, look, in short of like not being able to do it before the round, like throw it in, your deck or very early in like some presentations. Like, look, we're gonna use 50K as the capital to like like, you know, mitigate this person or bring their stake down, etc. That is an easy and you come to terms obviously with other third party is you can negotiate the money you don't have. And I think most VCs will be okay if like you're not spending 20% of the new money, 10% of the new money, but you're spending some amount to make a hyper efficient cap table. Like that's okay for your what your working capital is going to be. I don't know. It's maybe a better question for Holly.
No, I mean, you can use that round for leverage, right, to get done what you need to get done. I think one of the other things I would add too is that sometimes the departed co-founder just thinks they have a ton of leverage and honestly just doesn't understand that what comes next is going to be completely out of their control. They can be diluted down in 9 million different ways. And so acting kind of in good faith and with good intention when you leave, especially when maybe you've been there for a year and you guys didn't have a strong vesting documentation and you really aren't going to be contributing to the ultimate success of that company. You should try to be fair in how you handle it because generally further down the line, you're probably going to lose out anyways, unless you do it the right way when you leave.
You guys brought up something that I hadn't really thought about in the messy cap table conversation, but it's interesting. And it's not necessarily all about percentage, it's about dynamics. Like the seed investor who's still on the board, who sort of, thinks they're this puppet master type, three rounds down and they're exerting undue influence because maybe they were the sort of first check. Love to understand, Holly, when you come into sort of an existing investor set, what is important to you about the dynamic that's going on and maybe what the cap table says about that dynamic?
Yeah, that's a great question because you can tell a lot. And I think you kind of have to. So I'll give you an example from probably the ugliest cap table I've ever seen. And this was a seed stage startup that I was asked to come in and clean up from the inside. You had 90 different investors with different instruments, terms, caps, warrant packages. If I could get that fixed to close a Series A, I think literally almost any structure is fixable. I think the question of is it worth fixing is an interesting one, and not all businesses should stay alive. But when I kind of tackled that cap table, you had 90 investors who had over time broken into very different factions at that point. And they were unaligned in a lot of different ways. And they all thought they had leverage or were master negotiators. And what I will say is that when everyone thinks that they have leverage, nobody actually has it because the alternative is kind of like, assured mutual destruction. But those dynamics can really kill things over time because you can kind of see those factions and where different folks are aligned and who's aligned with the current founder and who's not. And those can be table killers because there are people that in some respects would rather just watch it all burn down than actually kind of like get things done. There are of course ways around it, but that's just stuff that wastes time and money. So I think that is really important, especially when you have cap tables that have a lot of people on.
I was gonna ask Holly to hold my beer while I was like, I've had 120 Australian warrant holders come into a company, and it was every member of a different company. Yeah, but I agree. I mean, I think with all of this, like taking a couple steps back, like a cap table in terms of the far right column, what I say, the percentage column, like what we're trying to estimate is value to the company, right? Who's putting the right number, the right amount of value, like it, and if that really mismatches anywhere, you're never going to get that perfect. Tell founders if you get like 3 co-founders, estimate, 20, 20, 60, whatever it is, whatever the numbers are you come up with, you're never going to make it perfect, but like do your best to make a best guess at that time. Who's delivering what value to that company? What are the relative proportions? And as long as you get it close, that's good enough, right? We're not going to like punish anyone for that. It's when you've got really misaligned. This person holds this much and they're really valuable. This person holds a lot and they're not really valuable. That's really when we need to fix something to make sure the company's like everyone's properly incentivized to maximize the value of the company.
The thing I wanted to ask about too is you see a lot of these, here's the average dilution taken in any given round, and founders worry about a series of relatively clean, uncomplicated rounds. And sometimes things just take longer and take more money than they expect. And they are about to walk in and raise a seed or an A or whatever, and they don't feel like they're at the right level of equity. And they hear this, average, or they talk to their, friends who are in YC and say, oh, never dilute below a certain amount. And they want to know, like, is that real? Like, can I go out and raise my seed if I'm below X% on the cap table? Like, I'm fine with it. I know how we got here. I wouldn't have been able to get to this point of finally getting traction if I hadn't raised all this money. But I'm being told that I own too low. Holly, is that real?
In a lot of respects, it's kind of crap. I mean, like, I get it. When things work perfectly, you're going to give up the appropriate amount of dilution, and you should be in this spot by this time with this much capital. I just think, things rarely work like that. Obviously, you want to have the founders still have enough that they're extremely and insanely motivated to go do the job that they're, set out to do. But I just don't think life is that simple, and neither is raising venture funding. And then there's always ways later on where if you are contributing an extreme amount of value and this company is taking off, that you can get cut back into the equity in the appropriate way. So I don't think that's like a showstopper. I think that's also one of those kind of vague reasons that people will be like used to pass a lot of times too. I mean,
Colin,
if your
have you ever
founder at
seen
the end of it has 5%, like that's a different story, but yeah.
Colin, have you ever seen a founder just wake up one day and quit because they had a good company that just took a little while longer and they just didn't have enough equity in it?
No,
No.
I mean, like real founders, this is like a child. You're not like walking out on, what this is. But yeah, and I think Holly makes a great point at the end there. You can always true up, right? You can always get more, right? And we really see that in later stage, past the Series A companies where, okay, the founder still has a significant stake, but, often if they're fully vested, and I've seen so much of this since the Elon case, like let's put a package in place where they get more of the company, either more valuable, often more valuable, or revenue targets, whatever it's if the targets, and that can really align, both investors and a founder who's maybe already been working for 6 years, but you don't see a liquidity path for another 5. You should put something, I think, in that person's hands to incentivize.
Yeah, and I think one thing I actually more often see is some investors asking a founder in a company that's maybe going sideways or not working out or whatever. It's like, why are you still doing this? You only own X% of the company. Like, we're never going to get out from under this preferred. I rarely see the founder suddenly losing incentive. Sometimes I might have a realistic career conversation with this person that says, the most we could ever get for this company is X and you only own 2%. Like, maybe we should think about not raising another round, not diluting further, and maybe saving your peak earning years for something else.
And there are even structures there. Put a management incentive plan in place. I've seen that with companies that are sort of like tanking. Just like set aside some money to get the people who are running it, out. I want to say one more thing too. I would really don't listen to your friends at YC. And really, what I really mean is like really don't compare your company to anything else. Everyone else is unique. Like I've been doing this 15 years. Every company client financing that comes in is different, and you don't have to feel like you're pigeonholed into something or feel like other people are getting ahead of you in some way or that you should own more or whatever. Like if you feel you're okay, you're okay. And I think we get really skewed by, oh wow, Anthropic's got $300 billion to throw around. Like, why does my company we can't find 4 million? And again, like we only those that's what gets popped. Like there's a ton of founders out there looking for capital just like you are.
What is Holly, and I'll save this final question for you, and obviously anybody in the audience wants to add any questions. If I'm thinking about starting, and let's talk about like the founder conversations in terms of like equity splits and what's fair. What are the kinds of things that founders should think about when they're trying to figure out like what's fair between themselves that might get in front of potential repercussions later?
Yeah, I mean, I think you definitely have to work out the vesting piece very early and have that piece settled because things come up. And if the co-founder, like co-founders leave, these things happen. You need to kind of plan for the breakup and hope it never happens, but plan for it the right way. I mean, I like when, even if it's an even split, I still like to see a 51-49, that they've thought about what happens in that kind of scenario. I've seen a lot kind of in the 60-40 range. I have, there are a couple in the 50-50. Those kind of scare me. But if they do have the right vesting alongside of it, I guess it's a little bit more manageable. But it's always just properly plan for the breakup. And then, if it never happens, great. But I think you kind of have to go in with that mentality.
And what's something you each would offer out to investors who, you know, might be dismissive of a messy cap table that you would hope that they would take into consideration?
Ooh, I mean, I think there's just a ton of opportunity in those cap tables, right? I mean, you may, and especially now too, with kind of like, everything that's the SaaS, the apocalypse coming around SaaS and all these things. There's a lot of amazing software companies that might have some messy cap tables that just need a bit of a reset or a little bit of capital and structure it the right way that are going to be great businesses. So I think the investors that just immediately pass on a messy cap table, I mean, it's fine as part of their business model. Maybe it's a volume thing and they've got a huge pipeline of other things that they'd rather do. But I think you're leaving a lot of value on the table.
And a question actually just came up about founders taking some money off the table in secondaries and what your take is on that.
I mean, I think that's becoming way more common, given that these companies are staying private for just so much longer than they used to. I think it makes a lot of sense, like especially some of these huge rounds and valuations that are getting done. You can't have your employees, especially your employees, but even your founders locked up for 15 years without getting any liquidity off the table. So, I think, at the right ratios and stage, that makes a ton of sense.
One thing I'll throw out to keep in mind as sort of a final point, and Colin, you can sort of appreciate this, is during the close process. I've encountered like two situations that nearly killed rounds that were you have this preliminary cap table when one of your clients comes to you and says, "Hey, I'm raising this round, doled out the allocations. Here's where I think everybody is." And you always wind up making these last minute adjustments beforehand. Like the preliminary cap table is not necessarily the final one. I had a couple of instances where various accelerators had some follow-on provisions that had to do with valuation markups. Like, if this valuation is X, then we will definitely come in for our pro rata share. And it turned out the preliminary was like 0. And then when all the adjustments and whatever little negotiations, it turned out to be like 1.99. And they kept it to like a hard and fast. So like $500,000 disappeared from the round, like literally in the days before closing, because it wasn't actually a 2x markup. So, when you're doing those preliminaries and you're sort of saying, "Oh, are you in? Like, this is the preliminary. Is there anything I should know about the way your follow-on rules work, or minimum percentage ownership, or all of that sort of stuff?" Pro rata, making sure that if to make something work, somebody doesn't get exactly their pro rata number, that you have all those conversations beforehand, because some of that can get quite messy, and it's related to cap table stuff.
Yeah. I mean, on that, my math is got like an Olympic medal in gymnastics. It's so flexible. I would have found a way around that somehow. Yeah, and I think one other thing Holly said, no error is too big. Like no cap table issue is too big. It's all a factor of like how good your thing is, like and how much money wants to come in. And
And as long as
yeah,
you have reasonable people around the table.
Yeah.
yeah, people
Yeah.
you trust, like your current investors and your last investors.
For sure. Well, listen, Thanks so much for spending time with us. This was super helpful and super transparent. And I really appreciate you guys taking the time today. Thank you.
Thank you guys.
All right,
Thanks.
so
This is great.